Assalamu alaikum. Hey everyone, welcome to another live stream. And today, in each of these live streams, essentially what I do is I go through a specific sector and then a specific industry under that sector. And I just dig into the various companies there and try and figure out, first off, how the industry works. And then secondly, what companies would, in my opinion, make the best investment opportunities. And so that's really what this is all about. This is the sort of work that I do on my own. But me live streaming this gives you an opportunity to kind of see how I actually do this. And so that's really the big motivating factor behind making these public is just sharing that knowledge with you guys and hearing your feedback for how you do this sort of thing yourself. So anyway, again, for context, I'm looking for investments where the focus is primarily on deep value investing, where the companies are, in my opinion, fairly valued or undervalued, and not necessarily relying a lot on their growth prospects, but more on the assets that they have, the current balance sheet. I'm going to show you exactly how that works. I've already done a couple of videos on this before on chemical and fertilizers, and you can check those streams out as well. So anyway, what I do is I like going to this website Zacks and then just looking at sectors. They rank these I think weekly, and so they kind of give you an idea for the different sectors of the economy and what industries within that sector are performing really well. Anyway, so you can see, the first one is building products and mobile homes. That's one I'm going to be looking at today. So mobile homes and RV builders. And you can see total return over the past few months has been phenomenal, 42% since the beginning of the year. And we're just in March. And you can see it's outperformed the S&P 500 significantly, which only returned like 5% this year. And so, yeah, this looks pretty cool. I also pulled up, the IBIS World article on RV manufacturing, just to give me an idea. So before kind of picking companies within this sector, it's a good idea to understand what the sector is all about, what it depends on, how it ties into the rest of the economy. And that's really what I'm trying to figure out. So the first part is just trying to figure out, okay, how can I actually understand what's going on in this sector? And then the second part is figuring out, okay, what companies exist here that I think could be fairly valued. So, okay, let's take a look together, right? Recreational vehicle manufacturing. That's this guy right here. Key external drivers, domestic trips by U.S. residents, adults aged 50 and older. Okay, so it seems like a big driving factor is adults aged 50 and over. These are the kind of people that would buy RVs. Okay, probably a fairly safe assumption. Yield on 10-year treasury note. I know it's been bouncing around a lot lately, but now I think it's close to the 1.6%. The 10-year treasury. Yeah, okay, I already have that open. Okay, and then trade weighted index, world price of crude oil. Okay. Yeah, naturally that's gonna have an impact. So 10x, 1.64, it actually went up. Interesting. This is the 10-year treasury yield. And so if it goes up, it's usually an indication that interest rates are going to follow. Okay. All right, pretty interesting. So these are kind of things that you'd expect. RV manufacturing, okay, truck, trailer, and home manufacturing, that's going to impact RV manufacturing, household appliance manufacturing, because the RV is going to have some appliances in it. Makes sense. Aluminium manufacturing in the US. Okay. All right, so that's kind of the raw material from which I guess the structure itself is going to be made. And then auto parts and a bunch of stuff as well. This is the second tier suppliers, the suppliers of the first tier suppliers. The buyers are consumers in the US. Naturally, this is a consumer industry. Tourism in the US as well. Okay, so maybe people that rent RVs. So RV rentals would depend on tourism, sure. And the dealers themselves. So you could have dealers that would then sell to consumers. Second tier buyers is wholesale and home furnishing wholesaling. Okay. All right. That kind of makes sense. Major players: Thor Industries, Berkshire Hathaway. What? Berkshire Hathaway? Really? How's that? Holding company. Okay. They probably have. Oh, okay. Participates in the RV manufacturing industry through its Forest River subsidiary, which has, okay, Forest River, of which, like, the Forest River subsidiary also has a Coachman Industry subsidiary. Okay. All right. That's good to know. Cool. 20 billion revenue on the industry itself. Annual growth is like 1%. It's projected to be 1.9% over the next 5 years. Okay. Wasn't doing that great. So profits actually dipped 2016 to 2021. And for the next 5 years, I assume they're expecting profit to go up because the revenue is going up, right? Profit margin also dipped in the last 5 years. There are 608 businesses in the industry, 80,000 employees. Okay. Oh, these are the big players. So Thor Industries, Berkshire Hathaway, through Forest River. And then there's Winnebago and a bunch of others. Okay. I know there's a company, Camping World. Just because that CEO, Marcus Lemonis, has that show, The Prophet, the TV show. I think he's still CEO. Yeah, that's interesting. Cool. And so, okay, different products and services: Class A motorhomes, Class B travel trailers, fifth wheel trailers, Class C, and folding campers. Okay. All right, so I guess this would be like a recovery play, right? You have recovery. A lot of people are going to be spending time in RVs. I guess they'd be working remotely. So maybe not a recovery play, but kind of a bet that remote work is going to continue happening. And yeah, I don't know if it's possible to actually work remotely. I mean, maybe it's not just going to be 50-year-olds, but you're going to get growth from a lot of people just choosing to work remotely in campers. But that, of course, presupposes that you have everything that you need, like electricity and internet. I don't know. I don't want to make assumptions about an industry I have no previous experience in. Okay. Uh, Growth went crazy in 2016, 2017. Like revenue. Okay, cool. All right. I mean, this is good to know. I just wanted a general idea about the industry, and I got it. This seems pretty cool. I wanted to see industry financial ratios just to give me a benchmark, but it looks like we won't have any. All right, so they've already given us three names to start with. Thor Industries was the first one, so let's go ahead and check that out. I made a change to the sheet, by the way. You'll notice that there are other tabs down here showing a bunch of companies, and it actually changes, it starts to change as soon as I update the ticker right here. And what it's doing is it's pulling out the list of peers from Seeking Alpha, and then pulling in the financials for each of the different peers, so that way I can do comparisons directly without me having to look up the peers individually myself. So that's super helpful. Anyway, I'll let it do its thing. And in the meantime, we can just analyze the financials. I don't know why this is stuck. Oh, this part is stuck. All right, so Thor Industries, again, let's take a look at the description real quick. Manufactures and sells RVs and related products and accessories in the US, Canada, and here. Yeah, no kidding. All right, cool. It provides its products to independent and non-franchise dealers. Okay. Cool. Sounds good. So you can see let's see the debt level first, because I want to get an idea for what debt level is, whether it's a halal investment or not, because I'm not really interested in companies that are just debt ridden, ridiculously leveraged, way too risky, and they're not halal. So anyway, that seems okay. Like it was actually operating without debt up until recently, and now it's taken on about $2 billion in debt. But it's just a small portion of revenue. Revenue trailing 12 months is 9.2 billion. Issued shares. They've been buying back for a while, and then 2016 they started issuing more shares. Okay, not very. Like, change in share count is minimal, so I wouldn't be too worried about that. Let's take a look at the financial position, like a credit analysis, a quick credit analysis, see if there's anything there. It's 2 billion debt to equity is 1.5, a bit on the high side, but that's okay. Equity multiplier is 0.4, quick ratio 0.7. Okay, the quick ratio is low. I like to see quick ratios over 1. So that's kind of concerning. Cash ratio is 0.1. Yeah, I don't like that. Interest coverage, though, is 5.7. So if you take operating income and divide it by the interest expense, it's enough to cover 6 years. And cash over interest, though, is 2. So still okay, I suppose. You know, if they take the cash that they have and they use it to pay interest, it would cover 2 years of interest expenses. So I guess that's okay. Yeah, not too worrisome. How's this going? All right, stream link's okay. I guess that's okay. Yeah, not too worrisome. All right. Cool. So yeah, I mean, a few concerns there. I'm not entirely sure about whether this makes a great option. I'm gonna go ahead and create the sector. I think this would be consumer discretionary. All right, so again, like from a halalness perspective, there are a bunch of things that I consider, but the primary thing just being debt, and debt relative to revenue, interest expense relative to total expenses, interest income, if there is any interest income, relative to the total revenue as well. So I don't have the income statement here, but I think it's pretty safe to assume that this is not going to be a concern, just because like debt to overall revenue is so tiny, like it's so minuscule, and the fact that they haven't been operating with debt. About 5 years ago, they had zero debt on the books, so it doesn't seem to be like a huge, a material part of their business. So not too concerned about that. So credit assessment, I said, okay, what are the concerns? Quick ratio. Quick ratio is less than 1, so that's a red flag for me. That's concerning. And so the current assets are not enough to cover current liabilities. That's what it means. Cash ratio is 0.1. Cash ratio 0.1. That's also concerning. There's also this other thing that you can do. You can check FINRA bonds to see if there are any bonds issued for this company. You don't see this a lot with the smaller companies, but since this is a bigger one, I think we might be able to find something here. Nope, nothing. All right, just thought I'd check. But cash over interest is 1.9. Interest coverage is 6. So I like the fact that interest coverage is 6. So that tells me, and once again, like interest coverage is operating income, I believe, divided by interest expense. Yeah. So it seems like the income is going to be more than enough to cover interest expense. So yeah, not a huge bankruptcy risk, but I think it's there. Like you need to discount the multiplier that you use, just because there does exist some bankruptcy risk. Like I'd say that there's a small chance that the company might actually go bankrupt. I I wouldn't discount the probability entirely. All right. Assets. 115. Tangible book is 68. Whoa. Tangible book is 68, but assets is 115. Whoa. The intangibles there must be a nightmare. Whoa, look at that. Oh, dear Lord. So this typically means they've been going on an acquisition spree. And it does kind of look like that, right? You can see they have a bunch of brands. Maybe they've done a bunch of acquisitions over time. I bet just looking at this, you're going to see that they had a ton of acquisitions, especially this past, what is this, 2019? They went nuts. Yeah, that's a lot. That's a lot of goodwill on the books. Okay. All right. So I'm just going to ignore assets entirely. Our focus is almost entirely on tangible book anyway. So tangible book is 68. Book is 46. $3 per share. Liquidation to common 0.1. Okay, that's just a joke. And liquidation to common is just my metric for tangibles minus liabilities. As long as it's positive, it means your tangibles are greater than your liabilities. So I guess that's a good thing. Dividends. Okay, this is nice. This is nice. Okay, I like seeing this. They're actually paying out a dividend. That might explain the low cash position. Okay. All right. All right, cool. So, all right, so this gives me an idea. So between cash and tangible book, 3 to 68, that's the kind of price range. I'm gonna put a discount on tangible book based on our assessment of the company's operations. So let's go ahead and take a look at that. We have gross margins 15, historically high, which is good. EBITDA per share, EBITDA margin is 9%, so kind of in line with historical averages, except the past couple of years, so that's good. Okay, EBITDA per share is 14. Nice, 14. Operating margin 6%. Okay, a bit lower than what it was historically. Like you can see, maybe 2016, 2017, it was around that 8% mark. And then, okay. Yeah, I mean, I don't know what to tell you. Operating margin is not great. Operating margin a bit low. Operating margin historical. 8% versus, or rather 5% versus 8. So maybe you want to look into that and understand why is operating margin going down. Maybe it's because of all the acquisitions that we said happened around the time where they marked a ton of goodwill. Where is it? Goodwill. Yeah, that was here, 2019. Maybe it could be. Like you see that a few times. I've seen it a few times already. Net income margin 5%. It's actually down. To have 2%, 4% versus historical net income margin of 5%. It's also slightly down. So 5% versus, it's actually 3 versus 5% historical. So maybe try and figure out why is net income margin dropping. I want to understand that because that's a very important point. If there's something structurally wrong, you want to know about that. But if it's really just lower demand, as we can see over here, your kind of revenue dropped, and wow, that grew like crazy between 2016 and 2017. I remember seeing like there was this chart. I don't know where that was. Oh yeah, it was here. Industry performance. I remember seeing that chart where it just went up like crazy in 2016. I was like, well, what actually happened there, right? Yeah. Anyway. All right, so that's that. Earnings per share, $7. Wow, that's really good. I mean, that growth in revenue is ridiculous. $7 per share. That's really nice. Operating cash flow positive. Net cash flow is negative because they were what? Financing debt? Oh, they actually got debt. They took on debt. Maybe they paid back some of it. Bought back shares? No. So why is net cash flow negative? It's either share buybacks or dividend. Okay, they do have dividends, so they did pay dividends. Okay. All right. And then asset turnover is, yeah, it's a bit high historically. Asset turnover, you don't want to see high asset turnover. So let's check how much inventory they have on the books to see if there's a real concern. Whoa. Wow. Look at that spike in inventory though, huh? That is scary. Why do they have so much inventory? Okay. All right. 1.3 billion. That is a lot of unless they're anticipating ridiculous demand. I'm having a hard time understanding why that is. That's crazy. Wow. That is a ton of inventory. Anyway, so how would I value this? Again, like this is a new industry. I don't know. I don't have comps, so I'd probably have to look at comps. Speaking of which, why aren't we seeing the peers? Oh, look here. I do have industry figures here. So 5% is net income margin. So typical net income margin, around 5%. Okay. Asset turnover, typically 156. Here we're not seeing anywhere near as close. Yeah, it just went crazy. I mean, it is pretty high, but yeah, it is pretty high. There's no but there. Return on equity is decent. 17% return on equity. Return on invested capital about the same. Yeah, I think that's decent. So, okay, coming back to the share price, I think it's going to be a fraction of tangible book. And since they're paying dividends, they've been pretty consistent about it. I'd say probably 10x, so $15 just for the dividends. So paying for 10 years of dividends. And then tangible book. What fraction of tangible book? Probably a multiple of the beta, right? Maybe 2, 3x, 3x beta, 2x, 2, 3. If you take like 3x, that's 50. Plus that, that's 60. Whoa, 140. Okay, that was completely mispriced. Why is that though? They're trading at revenue. Wow. It doesn't look cheap to me. Like, I don't know, that's why, having these peers over here is going to be really helpful because I can just click on it and see, okay, what is the multiple that they're giving others? So you can see price to book is 3, so forget price to book because the intangibles are just ridiculous. It's 2.7 times. No, I mean, okay, that's price to assets. So what am I talking about? Price to book is 3, and price to tangible book is 2.7. What is price to tangible book? Okay, 3, 2.7. Okay, so similar. WGO actually has 1.2, and it's revenue. And you can see, all right, what's net income? Net income. Hey, it's about the same. Doesn't look very different. Looks very similar, actually. So if I had to pick between them, I'd say, Thor is a better option because they're literally cheaper on all metrics. Tangible book, beta. Yeah, it's cheaper on all metrics. So not really interested in WGO. This workhorse. Battery electric vehicles. What? Okay, what's this got anything to do with this guy? Why is it on the list of peers? That's weird. Plus, they don't have any revenue. I don't know why they'd put them as a comparator. Electric vehicles in Canada. Again, no revenue. Okay. Okay, this just doesn't show up. I guess it's an OTC company. And TTM? Tata Motors? Really? Do they have recreational vehicles? I don't think they do. Oh wow, we've been going at this for 25 minutes. But again, like in all fairness, we're not just considering a single company. We're actually looking at a bunch of these to get a feel for what that looks like. So it's not profitable. I didn't know Tata Motors was not profitable. Anyway, coming back to this main company, Thor Industries, it seems like, so if you look at it historically, EV over revenue is pretty high. Historically, price to book is relatively high, 3. It hasn't gotten this high since 2017. And also historically, price to tangible book is looking really high. But if you look at EV over EBITDA, which is probably like the core metric for this sort of business, I don't know, like I don't know, 13 versus 6, 13 versus 6, 8, 9. I mean, 12 doesn't look ridiculously expensive when you look at it in terms of EV over EBITDA. Price to earnings, it's relatively low historically. So it seems like, okay, maybe this is a good option. I mean, the outlook seems to be positive. I don't understand what the drivers are for this outlook. It seems, oh, you can see here, this is really useful. Industry structure, capital intensity low, technology change low, globalization low or steady. Regulation is medium. Revenue volatility is high and competition is high. World price of crude oil. Huh. Low capital requirements. Yeah, that's good. That's good, right? That's good. Well, this is not correct. 2016 to 2021 annual growth. Yield on 10-year treasury note dropped 0.8%. And it can be expected that this yield will go up, but how would the yield impact this? I assume a lot of these vehicles are financed, and the interest rate that these people would pay, consumers would pay on the financing is probably variable rate, right? Yeah, okay, so that's going to get impacted by the treasury note. Because long-term interest rates are impacted by treasury yield. Okay. All right. I mean, maybe it's good opening up a position in this company, and it seems to be like a pretty strong company. One thing I do before I decide to invest or not invest is check Seeking Alpha just to understand what's going on. Maybe there's existing analysis there. Okay. Let's not beat around the bush. Long-term debt down. Okay. Thor Industries PE ratio is 24. Yeah, it's about 20 at what I'm looking at. Okay, let's look at the comments. Comments is where you see like a lot of this action. 5% for 7 months. Okay. Okay. Pretty poor commenting there. No, I don't see anything useful. Yeah, you can see all of the related stocks here. These are the stocks that I have down here. It gets pulled in from Seeking Alpha. All right, so let's take a look at the chart just to get a feel for what that's looked like. Whoa, okay. All right, so I was saying, especially if a new industry I don't have any background in, I want to buy when people are selling. And you can see that this is definitely not the case here. Like people have just been buying like crazy, especially after earnings. Earnings happened, what, 9th of March? Yeah, that was last week. So earnings happened and just really rebounded like crazy. It went from, wow, this would have been a nice entry point, 114. It just bounced straight up to 140. But right now, it's just way too hot. Like, what I'd want to do is get in at, say, 50 RSI on the 4 hours. Oh, or even higher on here. Yeah, around the 114 mark. I think that would make sense. Around 114. Current RSI is closer to 65. So I kind of feel like, okay, story, regardless of story, it's really a bet on the industry itself growing. And what are the drivers of growth? I don't know. But maybe worth just opening up position, just to get exposure to the market. Okay. Yeah, I want to look at some of the other ones as well. We'd seen, so we saw Thor. There was mention of the is it the Berkshire Hathaway one? Forest Rocket Force, something like that. Competitive landscape. Let's take a look. Yeah, major companies. Berkshire Hathaway. Winnebago Industries. Winnebago. Well, we already have that here, so might as well just take a look. Okay, yeah, and I did do a quick comparison here. Okay, it looks like growth is okay. Debt is less than Thor, so I like that. Quite quick ratio, cash ratio. I mean, especially like one of my concerns with Thor is like you need to discount it. You need to discount it based on this credit assessment. Because again, like there is some risk. There is some risk of bankruptcy. So even though that requirements are not that high, you want to be wary of that. So that's why I don't like the price. It's too expensive as it is right now. And if that's too expensive, I mean, look at this, right? It's even more expensive. But why? Let's see if we can figure out the drivers here. So debt, minimal debt, again, up to 2016. That's when they started piling up. So I wonder if there's something that happened in 2016 to force several of these players to pile on debt. Cash ratio is okay. Interest coverage, cash over interest. So much better debt position than from a credit perspective. It's actually much better. Winnebago is doing much better. Okay. Also, look, they have this thing where they have a lot of intangibles. I don't know what that deal is. Acquiring companies. So tangible book is 30. Book per share is 25. Okay. Cash is 8. Liquidation to common is 3. And they're also paying a dividend. Okay. Gross margins 15. Beta is 8. All right. So the beta is a bit low relative to historical trends. Operating margin, net income. Net income is a bit low. Solid earnings per share. Net cash flow is positive. Nice. Again, you have inventory kind of high. It does look like they're piling on inventory, probably because of what happened last year, right? With COVID. They have more inventory as a result. that might be a concern. Inflated assets and whatnot. Okay, so price wise, and also ridiculously nice return on invested capital here. This is very nice. It's superior to Thor. Superior to Thor. It's impressive. Okay, so price wise, what are we looking at? So historically, yeah, it's definitely expensive historically. Like you can see, 3 times book, 2.7 times tangible book. So it's just been driven up, especially recently. Like this is in November. In the last 4 months, it's just gone from 17, a PE ratio of 17 to a PE ratio of 27. Wow, ridiculous. So yeah, I just don't see it. I don't see it. I don't buy it, you know? Sure, it's from a credit perspective, it looks better, but still, man, like the multiple there is ridiculous. I can't imagine people recommending this and not recommending Thor, unless there's something secular about Winnebago. Well positioned for continued growth. Yeah, that was in November, right? That was in November. Things were looking pretty good in November. It was 47. Now it's almost double that. It's 83. Yeah, not much coverage here. Oh, yeah, I just don't see it. Not gonna do it. Not gonna do it, definitely. So you can compare that to Winnebago. Yeah, it's even crazier. Yeah, not happening. All right, so not those two. And then you have Berkshire Hathaway, but Berkshire Hathaway gives you. Can you see Berkshire Hathaway? What was it? Berkshire subsidiary Forest RV Camp. What's it called? Forest River. Forest River. So I guess they're not going to trade independently. You'd have to buy Berkshire, and I don't want to buy Berkshire. And Berkshire has a lot of financials. I don't think it'd be considered that, so not an option I'm considering. Forest River. Yeah, I don't think you can buy it on its own. Oh, you can? Nope. River? What is this? Yeah, that's all right. Yeah, that's it. I guess those are the biggest players in the industry. And then let's see if there are a few more that we can take a look at. So that's Thor. Not crazy about Thor, you know. I would. So what I can say is I'll set up an alert for, was it 114? I'll set up an alert for 114 and just see what happens. But again, like if by the time this alert triggers, the industry's just been killed, then yeah, maybe it's worth reconsidering. I don't know. So we've checked out these two. Let's take a look at CAFCO CVCO. Let's see what that's about.